Hello students, how are you? Hope so. You must be doing good. अच्छे से आपका your preparation must be going on very well. है ना? Today we are doing the revision of the remaining portion of our chapter non-resident, and then we'll start with the last chapter double taxation of water agreement. Okay. So in the last class we discussed most of the part of the non-resident taxation. Now in today's class we'll discuss the remaining one. Let's start with. So, as we all know, that non-residents are taxed at special rate in respect of some of the prescribed income. Okay. So, there is section 115 AB, which is applicable only on overseas foreign organizations, which provide a special rate applicable to it in respect of income from units purchased in foreign currency. So, any OFO, if it purchased units in foreign currency, then from such unit, it can either derive the interest or long-term capital gain on sale of such units. So interest is taxable on gross basis at the rate of 10%, and long-term capital gain is taxable at the rate of 12.5%. So this section is applicable on OFO in respect of income derived from units purchased by it in foreign currency. In this regard, it says that the interest from such units taxable at 10% on gross basis, meaning no expense, no deduction shall be allowed, and long-term capital gain arising from transfer of such units shall be taxable at the rate of 12.5%. Okay. In this regard, the benefit of first and second proviso for computing the long-term capital gain shall not be available. Deduction chapter 6A is not available. However, the OFO is eligible for the setup of brought forward losses or basic assumption limit in respect of this income. Clear? What do you mean by OFO? Overseas foreign organization means any fund or institution established in a country outside India, which have entered into an arrangement for investment in India. So this organization, this fund has been incorporated outside India, established outside India, but for the purpose of making investment in India with any public sector bank or public financial institution or mutual fund, and such arrangement is approved by the SEBI. If you are such kind of fund, then you will be qualified as OFO. And for OFO, the section 115 AB says that the income of OFO from units purchased in foreign currency shall be taxable at a special rate. The interest from such units taxable at 10% on gross basis, and long-term capital gain on sale of such units taxable at the rate of 12.5%. Then there is section 115 AD, which is applicable on FIIs, foreign institutional investor or specified fund. So it's applicable in respect of income derived by these FII or specified from any security except the units referred to in 115 AB. Okay. So the income can be in the form of interest or dividend. Such income is taxable on gross basis at the rate of 20%. However, the rate shall be 10% for specified fund. And this is except under section 124 LB, LC, LD, and 115 AC, where there are different or concession rates are given. So LB, LC, or LD provides a rate for interest. 115 AC provides the taxability of GDR. Okay. Now, capital gain arising from transfer of the securities. If such capital gain is short-term capital gain, short-term capital gain shall be taxable at the rate of 30%, except under section 111A, 111A, and long-term capital gain is taxable at the rate of 12.5%, except under section 112A. The except section 111A or 112A means if the assets, if the income is of the nature specified in a subsection, then such income shall be taxable at the rate provided in a subsection. So HTCG other than 111A, other than 111A shall be taxable at the rate of 40%. Similarly, LTCG other than 112A shall be taxable at the rate of 12.5%. Similar to 115AB, no deduction, no benefit of first and second proviso is allowed against this income to FII or specified fund, but they're also allowed to set off the brought forward losses, and they're also eligible for the basic assumption limit against this income. Okay. it says the proviso of section 115 AD shall apply to a specified fund. So 115 AD applies to a FII or specified fund, which says that it shall apply to specified fund only to the extent of the income that is attributable to units held by NR, not being P of NR in India, calculated in the prescribed manner. So this concessional tax rate is applicable to specified fund only to the extent of the income which is attributable to units held by it, held under it by the non-resident. Okay. So only income attributable to such non-residents shall be eligible for the benefit of section 115 AD, others are not. So specified fund means the same, shall have the same meaning as provided in section 10 4D. Okay. So this was about 115 AB and 115 AD. 115 AB is applicable on OFO in respect of units purchased by it in foreign currency. The interest income is taxable on gross basis at the rate of 10% and long-term capital at 12.5%. 115 AD is applicable on FII or specified fund. Any income from security as the units referred to 115 AD. So interest and dividend taxable at 20% for FII and 10% for specified fund. But if such interest is taxable or the income is taxable under section 194 LCL, LLB, LCLD, or 15 AC, the rate provided under such section shall prevail. Similarly, short-term capital gain other than the short-term capital gain referred to in 111A is taxable at 30%, and long-term capital gain other than long-term capital gain referred to in section 112A is taxable at 12.5%. Right. Just remember, the benefit of 115 AD in respect of specified one shall be only to the extent of income attributable to the units held by non-resident in such fund. Now, section 115 BA. It provides a special rate for tax on non-resident sportsmen or sports association. So it says that where the assessee is a sportsman who is not a citizen of India and is non-resident. Because we are talking about a sportsman who is neither a citizen of India nor a resident in India. If such sportsman deriving income from India, then such income shall be taxed at 20%. So it says that we are assessing a sportsman who is not a citizen of India and is also not a resident in India. Then income from three types of income is covered under section 115 BB. Participation in India in any game or sport other than lottery. So income from any game which was held in India other than the lottery. Income from advertisement or income from contribution of article related to the game or sports in India. Only in newspaper, magazine or journal. So only these three income are covered under section 115 BA. So this income are income from playing the game in India, income from advertisement, and lastly income from writing any media articles, right, in India. So all these three income accrue rise in India and therefore taxable in the hands of non-resident, but such tax shall be at the rate of 20%. Clear? Where the assessee is a non-resident sports association or institution, income by way of amount granted to be paid in relation to any game or sport played in India. So here in the second point, we are talking about the sports association. In the first one, we talked about the sportsman. Now we're talking about the International Sports Association. If they are getting any money in respect of games played in India, then the income of such sport association, such non-resident sport association, shall be taxable at the rate of 20%. So there is a flat rate of 20% in section 115 BBA in respect of all the income referred therein. VSS is an entertainer. So now in the first point we covered the sportsman. In second point we covered the sports association. Now we are covering the entertainer. The actor, actress, or the whoever acts, right? Is an entertainer who is not a citizen and non-resident in India. His income is from performance in India, right? So if a person is an entertainer who is neither a citizen of India nor resident in India, and he derives income from India in respect to the fact that the performance was held in India, then such income shall be taxable at the rate of 20% in his hands. Right? This above income is taxable on gross basis. No expenses is allowed against the above income. No deduction of Chapter 6A is allowed. And also, if the assessee has only this type of income and tax has been withheld as provided in Section 15 BBA, the assessee is exempted from the requirement of filing return of income. So what it says, assessee is not required to furnish return of income if total income only includes income referred above and tax has been deducted on such income. Okay. So 105 BBA covers three types of person: one, sportsman; second, sports association; and the third, entertainer. For sportsman, he should be non-resident and a not resident. He should have income from either of three, only these three sources. One is from playing games in India, from advertisement; second, and lastly, from contributing media articles in the newspaper, magazine, etc. Right. Then we comes to the sports association if they are getting some money in respect of games played in India. Then lastly, the entertainers. He should also be neither citizen of India nor resident in India. And the performance was done in India. In all three cases, you will observe that the income actually accrue or arise in India. Therefore, such income is taxable in the hands of non-resident. But if such income is taxable in the hands of non-resident, then the income of the nature specified as discussed above under Section 15 BBA shall be taxable at the rate of 20% only. Okay. Now we are moving to Section 105A, GDRs, Global Deposit Receipts. So 105 AC says tax on income from bond or GDRs purchasing foreign currency. Who is eligible? Only the non-resident. Okay, of course. Nature of income and the tax rates. There. Interest income on bond or dividend income on GDR. They are taxed at the rate of 10%. No deduction on any expenditure allowance shall be allowed. The similar to earlier section, this income is also taxable on gross basis. Now, LTCG arising on long-term capital arising on transfer of these bonds or GDR. Such LTCG taxable at 12.5%, and benefit of first and second proviso section 48 is not available. Similar to above, no deduction chapter 6 shall be allowed against the above income. NR shall not, okay, as we discussed just in 105 BBA, in this case also, if the assessee has only income as referred in this section 105 AC and tax has been deducted in accordance with the provision section 105 AC, then he is not required to furnish return of income. So it says that NR shall not be required to furnish return of income if his total income only includes income by way of interest referred above and tax has been deducted on such income. Right. Now, Section 105 AC applies on foreign bonds purchased by assessee in foreign currency. Bonds issued by the Indian company according to the scheme of central government or bonds issued by the public sector company. So if a non-resident subscribe to the bonds issued by public sector company or any other Indian company, provided the scheme is approved by the government, and such subscription bond is made in foreign currency, the income from such bond is taxable under Section 115. 115 AC applies to following GDRs, government depository receipts purchased by assessing foreign currency from an approved intermediary. Okay. The bond was also purchased in foreign currency, and here the GDRs are also purchased in foreign currency. What type of GDRs? GDR issued in accordance with scheme of central government against the initial issue of shares of an Indian company, or GDRs issued against the shares of public sector company, or GDRs issued or reissued in accordance with scheme of the central government against the existing shares of Indian company. So these GDRs are issued against the shares of Indian company or public sector company, as the case may be. Okay. So we have done 115AB, which is applicable on OFO, overseas foreign organizations, in respect of units purchased by him in foreign currency. Then we have done section 115AD, which is applicable to FII or specified fund. Then we did 115BBA, applicable to sportsmen, sports association, or entertainment. Right? Then lastly, we did 115AC, applicable on GDRs of FCCB, means foreign currency convertible bond. Now, a new chapter, chapter 12A, which gives some benefit to NRIs. Not only to NRIs. NRIs mean non-resident Indians. But non-resident Indians have an option to opt for chapter 12. So it says who are eligible? A non-resident Indian being an individual who is a citizen of India or person of Indian origin and who is a non-resident. So you are either citizen of India or person of Indian origin and you are a non-resident, then you are non-resident Indian, NRI, then you can claim the benefit of chapter 12. So what chapter 12 applies? It applies on this type of income. What is? Investment income derived from foreign exchange asset. This income is taxable at the 20% on gross basis. No deduction of any expenditure allowance shall be allowed. For long-term capital gain arising from transfer of foreign exchange asset, this income is also taxable at the rate of 12.5%. When benefit of taxation is not available. Okay. Now, what do we mean by foreign exchange asset? Means any specified asset which the associate requires subscribe to in convertible foreign exchange. So foreign exchange asset means any specified asset which was purchased in foreign convertible exchange. Now, what do we mean by specified asset? Specified asset means any of the following assets: shares in an Indian company, debentures issued by the Indian company which is not a private company, deposit with an Indian company which is not a private company, any security of the central government, such as the asset as the central government may specify in this sphere. If any of these assets was issued or subscribed or purchased in the foreign currency, foreign convertible exchange, then such assets shall qualify as foreign exchange asset, and income from such foreign exchange asset shall be taxable under the is eligible for taxation under chapter 12A. So if it's an investment income, such income is taxable at 20%. In case of long-term capital gain, it is taxable at that 12.5%. Both are, the investment income is taxable on gross basis. Right? But this is the benefit. Now, what is the benefit? It says the long-term capital gain arising from transfer of foreign exchange asset shall be exempt. So this long-term capital gain, you are not required to pay even 12.5%. It shall be completely exempt if assessee has invested the net consideration in acquisition of specified asset, not the foreign exchange asset, within 6 months from the date of transfer of original asset. So it's talking about if an NRI has sold any of the foreign exchange asset, and on sale of such foreign exchange asset, it has derived long-term capital gain. Then such long-term capital gain shall be exempt if he has invested the net consideration into for purchase of any other specified asset, not the foreign exchange asset. Okay, clear? Hai? Where the assessee transfer otherwise converts the new asset into money. However, this new asset, new specified asset which you have purchased and claim the exemption, then there's a lock-in period of 3 years. But if you have sold it or converted into money within a period of 3 years from the date of its acquisition, then the amount of capital gain earlier exempted shall be deemed to be the LTCG of the previous year, in which a new asset is so transferred or converted. Okay. So exemption earlier given shall be withdrawn in the year in which the new asset has been sold or converted into money, if such conversion or sale is within a period of 3 years from the date of its acquisition. So it's very much clear? Okay. It says if part of the net consideration is invested, then of course only proportionate capital gain shall be exempted. Net consideration means full value consideration minus expenditure incurred in connection with the transfer. Interest referred to in section 194 LB, LC, and LD shall continue to be taxed at the rate of 5% and shall not be taxable under the provision chapter even in the year in which NRI opt to be governed by this chapter. Okay. Earlier ILD was there, now ILD has become redundant. Let's say that chapter 12, non-resident Indian is not required to furnish return of income. His total income only includes income referred to in chapter 12A, and tax has been deducted on such income. Clear? So similar to earlier section, here also the exemption is provided from filing return of income. If the non-resident is only the income referred in this chapter, then tax has been accordingly appropriately deducted thereon. Assessee may choose in the return of income not to be governed by the provisions of this chapter and in particular assessment here, and then in such case, the provisions, normal provisions shall apply. When non-resident Indian becomes a resident any previous year, if an NRI becomes a resident in India in any year, he may continue, so he may continue to be governed by the provisions of this chapter in respect of investment income from foreign exchange asset until the transfer or conversion of such asset into me. So even if you have came back to India and become a resident, or you are NRI, then also you can continue to opt for this chapter till the time the foreign exchange asset has been sold or converted in respect of investment income. Assessee has to furnish declaration to the AO along with return of income in this area. For this, you have to furnish a declaration to the AO along with the return of income. No deduction chapter 6 shall be allowed against the above income. So this was all about special tax rate which are applicable to NR. So first we discuss 115AB, then we discuss 115 which is applicable on OFO, then we discuss 115AD applicable on FII or specified fund, then we discuss 115BBA applicable on sportsman, sports association and entertainer. Then we discuss 115AC applicable on GDR, Global Deposit Receipt, and FCCB, Foreign Currency Bond. And lastly, we talked about Chapter 12, which is applicable for NRIs. Okay. Now, we'll discuss the TDS provision applicable to NR. So most of the TDS provision we have already discussed at the time when the taxability of such income was discussed. But here, we have consolidated all such TDS provisions which are actually applicable to NR. If NR is deriving any income from India, then what is the TDS provision at what tax is required to be withheld are discussed in this section. Okay. So let's start with section 195 TDS on payment to non-resident. Oh. Any sum chargeable under the Act other than salaries, interest, reference for LB or LC. So 195 applies on all sum chargeable under the Act. Okay. So if you're making any payment to non-resident, and if such payment taxable in the hands of non-resident in India, if such amount taxable in the hands of non-resident in India, then the payer is required to withhold TDS. It's different from the domestic TDS. In case of domestic TDS, there is always defined different types of nature of payment for which tax provisions are applicable. But now 195 is a general provision applicable to NR. It says any income of NR which is chargeable under this Act. If NR is required to pay tax under this Act, right? Then the payer of such income is obligated, is required, is mandatory required to deduct tax from such income under section 195. So deductor may be any person, so the payer may be any person, payer of the income, and recipient is a non-resident or a foreign company. The TDS rate, at what rate such person is required to withhold TDS, is the rate at which such income is taxable in the hands of non-resident. So TDS rate is rates in force. So time of deduction at the time of credit of payment, whichever is agreed. So all payments of non-resident subject to TDS. Right? at the rate which is applicable to non-resident on such income. So technically speaking, non-resident is not required to pay any tax at the time of final return of income, because in respect of all its income which it is deriving from India, the tax must have been withheld under section 195. Who is the director? Director is the any person, right? Now it says the word any person used above is intended to include both resident and non-resident. So a non-resident making a payment to another non-resident is required to withhold tax if such payment is chargeable to tax in India under Income Tax Act 1961 or 2025 in the hands of recipient. Okay. Therefore, a non-resident person is also required to deduct tax at source before making payment to another non-resident if the payment represents income of payee non-resident chargeable tax in India. Okay. Therefore, if the income of the payee non-resident chargeable tax, then tax has to be deducted at source whether the payment is made by resident or non-resident. In the case of interest paid by the government or public sector bank or public financial institution within the meaning of 1023D, tax shall be deducted at time of payment. So otherwise, tax is deducted at time of payment, okay, whichever is earlier. But if the interest is paid by the government or public sector bank or public financial institution, then they are required to deduct tax only at time of payment and not at time of credit. Deductor may request AO to determine the amount out of the total payment on which tax is deductible if the director considers that tax is not deductible on whole of such sum. So 195 gives an option to the payer and also to the payee to approach the tax officer and determine the rate at which tax should be deducted, or get a certificate that no tax is required to be deducted on the payment to be made to such amount. Okay. So firstly, it says that deductor, the payer, may request AO to determine the amount out of the total payment on which tax is deductible. So it may ask the AO that please let us know the amount upon which we are required to make a deduction of TDS before making the payment to the non-resident. If such person, the director, consider that tax is not deductible on whole such sum. If I feel that I am making a payment to NR, out of this payment, some is taxable, some is not, then I can get a certificate from the assessing officer that on which amount I should deduct tax, and such certificate shall be a great defense against any proceeding against me for short deduction of TDS. Similarly, recipient, the non-resident who is receiving the income, may also request its AO, assessing officer, to grant a certificate authorizing him to receive such amount without deduction of tax under this section. So a non-resident may also approach the AO and explain his case that the income which he is expected to receive from India is not liable to tax in India, and such if the AO is convinced, then he can issue a certificate that tax is not required to be withheld on such payment, and such payment is to be released without deduction of tax under this section. Okay. Now, every person making any payment to an NR or a foreign company, whether or not chargeable under this act, shall furnish the prescribed information in respect of such. So, government wants to know about the payments made to is going outside India, made to the NR, and therefore any person making such payment is required to furnish a report in Form 15CA, 15CB as a case may be, before which has prescribed information. Okay. Such information is to be submitted whether the income which is being paid is chargeable tax in the hands of NR or not. Okay. TDS on salary, section 192. Income chargeable under salary, director, employer, recipient, any person R or N. So if an NR is receiving a salary from India, if such salary taxable in India, then TDS on society director in section 192 and not 195, because we see 195 excludes salaries other than salary, right? So if you are making a payment of salaries in the nature of salary which chargeable under this act, which taxable in India to an NR, then you are required to do TDS under section 192 and not under section 195. Okay. So 192, we understand the tax deducted average rate of income tax computed on the basis of rates in four on the estimated salary income of the assessee. Time, at what time the tax is deducted? The tax is deducted at time of payment and not at time of credit. Now it says that by virtue of section 912, salaries deemed to accrue or rise in India, services are rendered in India. So when the salary is accruing or rising in India, if the services for such salary has been rendered in India, physically in India, then the salary for receive for such service shall be taxable in India. Therefore, if a non-resident renders service in India, the salary income will be chargeable tax in India on the basis of actual accrual and or a rise, and employer has to get withholding tax in accordance with the provision section 192. Because even if payment is made to ANA, but the payment nature is salary, then tax is deducted in section 192, otherwise 195. And the rates in force for the financial year in which the payment is made. In case where salary is payable in foreign currency, the amount of tax deducted is to be calculated after converting the salary payable into Indian currency. So I need a Indian currency amount at TTBR adopted by SBI as on last day of the month immediately preceding the month in which the salary is due or paid in advance or in ALS. Okay, I explain you with the example. So it's saying that if you are making a payment of salary in foreign currency, say for the month of June 25, then to convert such currency into INR, you will use the exchange rate as it applicable on 31st May 25. So last day of the month, immediately preceding the month in which the transaction happens, in which such income becomes taxable. Okay. Section 192A, TDS on PF amount. So it says that what is the time? So if a non-resident is getting any PF amount from the PF trust, then the PF trust shall withhold the tax under section 192A in respect of accumulative PF amount if taxable in the hands of employee. If the amount received by him is taxable in his hand, only then the TDS provision section 192 is applicable. If the amount received fully exempt in his hand, then there is no requirement to TDS. Clearly, because TDS at the end of the day, TDS is nothing but a recovery mechanism. So before recovering a tax, there should be chargeability of tax, right? So it says that if the amounts received from the PF is exempt, then there is no requirement to withhold. So 192A comes into picture only when the amount received from the PF authority is taxable in the hands of NR recipient. Okay. Then such trustee of the employee PF scheme or any other person authorized under the scheme shall deduct the tax. Okay. Recipient may be R or NR. Okay. The tax is deducted at the rate of 10% and at the time of payment, as was there in case of salaries. However, the threshold of 50,000, that is, if the amount of paid is less than 50,000, no TDS. If the amount paid is 50,000 or more, then there is a TDS of 10%, provided such amount is taxable in the hands of recipient. And 194B, lottery income. So winning from lottery for purpose of card game or other game of any sort. Director may be any person and even the recipient can be any person. So if a non-resident has won a lottery in India, then such income shall be taxable in India, has received lottery money in India, and the payer shall deduct a TDS of flat TDS of 30% before releasing the gift to the NR. Here also, the tax is deducted at the time of payment. No TDS if the amount paid does not exceed 10,000. The threshold is only 10,000 or less. So if the amount for paid is 10,000 or less, no TDS. If the amount paid is more than 10,000, then there is a requirement of TDS. TDS winning on online game 194BA. So if you have seen, in case of 194B, winning from lottery, tax added 30% deducted on the gross income, rather gross receipts, right? But under section 194BA, in case of online gaming, the tax is deducted at 30% on net winning. So this fine difference you have to keep in mind. Okay. It 194B applicable on winning from online games. The extra may be any person, recipient may also include NR. So if NR has won any online game in India, then the player shall get a tax of 30% of net winning. And tax is to be paid at the end of financial year. Net winning means the winning amount minus the amount required to play that game. So the difference, the net winning, which is net income, should only be taxed at the rate of 30%. Then the income section 194 double B. Earlier we did the B winning from lottery, then 194 BA, winning from online game, and now 194 double B. It is winning from horse races. So nature payment is winning from horse races, that is any person, recipient also any person to include NR also. Tax rate is at 30% at the time of payment. Exactly similar to what we discussed in 94B. The threshold is also up to 10,000, and this up to 10,000 here also in case of 94B is per transaction limit, not the accumulated limit. So you have to win if you have won 10 lotteries of 9,000 each, then no tax shall be deducted because each individual loyalty is below the threshold of 10,000. So we will not see the aggregate amount of won during the year. We see for the lottery and the horse races, a 10,000 assumption shall be seen for each transaction and not for the entire. TDS on commission sale of lottery with section 94G. So commission remuneration or price by whatever name called on lottery tickets. Victor may be any person, even the recipient can be any person, so it may include NR. Who is stocking, distributing, purchasing, or selling lottery tickets. TDS rate is 2% at a time of credit payment, whichever is. So for all commission nature payment, the TDS rate is 2% and the threshold is 15,000. Okay. Now 194N. TDS on cash withdrawal. The nature payment is payment in cash in excess of rupees 1 crore. Okay. So if you're withdrawing cash from any of the bank in excess of rupees 1 crore, then the bank shall withhold tax under section 194N. Who shall withhold tax? Any banking company, cooperative bank, or post office. Only from these sources you can withdraw the cash. Recipient may be R or NR. So even if NR has withdrawn cash from Indian bank, then such bank shall get tax of the NR under section 194 and only. So TDS rate is 2% of sum exceeding 1 crore, 3 crore in case of cooperative society. So TDS rate is 2% on the amount withdrawn in excess of 1 crore. However, if the assessee is the person who is withdrawing the amount is a cooperative society, then tax shall be withheld 2% on the amount exceeding 3 crore. So they are given a benefit of 3 crore, while for all other assessees, the benefit is only up to 1 crore. Okay. And the 1 crore and 3 crore is the aggregated figure for the financial year. Of course, tax rate at time of payment, there cannot be any credit. How can banks know that when we look come for withdrawal? Also, where the return has been not furnished in the return of income for all the 3 previous years, 3 earlier years, then tax shall be deducted as under 2% of the amount withdrawn in excess of 20 lakh and 5% of the amount withdrawn in excess of 1 crore, 3 crore in case of cooperative society, as we discussed just now. Okay. Now, TDS on payment to non-resident sportsmen of sports association, 194E. So it talk about the income referred to section 115 BBA. We just did 115 BBA, but it said that for sportsmen who are not a citizen of India or not a resident in India, if he is deriving income from playing matches in India or from advertisement or from contributing to media articles, then such income is taxable at 20%, and the payer is required to withhold tax on such income section 194E at rate of 20% only. Clear? Sports association deriving income from matches played in India. Such income is also taxable in India and benefit section 115 BBA can be availed and the tax rate shall be 20%. However, the payer shall also be required to withhold tax at the rate of 20%. Okay. Lastly, 115 BBA was applicable in case of entertainer who is neither a citizen of India nor a non-resident. Not a resident in India. Means he's a non-resident in India. Then such entertainer is deriving income from performance in India. Since performance happened in India, is taxable in the hands of such person at the rate of 20%, and the payer shall deduct tax at the rate of 20%. Right? So nature of payment is income referred to section 115BA. Director may be any person who is making the payment of the nature referred to 115BBA. Recipient may be non-resident sportsman who is also not a citizen of India, or non-resident entertainer who is also not a citizen of India, or non-resident sports association. All the three types of person are mentioned in 115BBA. So the tax shall be withheld at 20% at time of payment of credit, whichever is allowed. Okay. Threshold limit is rupees 1 lakh. Now see an interesting point. It says that whether umpires and match referees can come under the scope of 115BBA. So 115BBA is applicable on sportsmen, sport association, or entertainer. So of course, the umpires are not entertainers; they are not entertaining you. Secondly, they are not sport association. So can we call them sportsmen? Tell me. If the answer is yes, then they can be covered under 115BBA. If the answer is no, then they're out of 115BBA. Because the last two category of person, generally they don't fall. Very, very straightforward. But can we call them sportsmen? The answer is no. So it says that umpires and match referees can be described as professional or technical person who render professional technical service. But they cannot be said to either non-resident sportsmen or including athlete or non-resident sports association or institution so as to attract the provision of section 115BBA. And consequently, the provision of PDS under section 194E cannot be attracted. So any amount received by umpires or match referee in respect of games played in India, such amount taxable in his hands. But they cannot avail the benefit of section 115BBA because 115BBA is applicable on non-resident, non-citizen sportsmen. So they are out of definition of sportsmen. Okay? And therefore, even in their case, the TDS section 194E shall not be deducted. Rather, TDS shall be deducted in section 195. Why TDS section 194 is not deducted? Because the income does not qualify 115BBA. And the income does not qualify under section 115BBA, then 194E cannot apply. Because 194E applies only on the income referred to in section 115BBA. 194T, sometime back, not a very old section. So it says that what type of payment they are covered? They are covered in the payment of made by partnership firm to the partners. The distribution and is sum by firm in the nature of salary, remuneration, commission, bonus, or interest to the partner in the firm. The partnership firm is distributing surplus to the partners in the form of salary, remuneration, commission, bonus, or interest. Then that firm has to become a director. The recipient shall be partner in the firm, which may also include NR. And the firm has to require to get as the 10% at time of credit payment, whichever is earlier. Threshold limit is 20,000. Now, these are some special section in respect of TDS on interest payment to non-resident. It says that 194LB is a concessional section. It's applicable on interest payable by infrastructure debt fund. If the loan is taken by the infrastructure debt fund, the interest paying to the NR for a foreign company, then such infrastructure debt fund is required to withhold tax at the rate of 5%. And such income shall be taxable in the hands of non-resident at the rate of 5% only. So they will not be required to pay any other tax, any other amount at the time of filing return of income. 194 LC. So under LB, the money was borrowed by infrastructure debt fund. Under LC, the interest is payable on money is borrowed at any time before 1st July 2023. If the money was borrowed before 1st July 2023 in foreign currency, then only benefit of 194 LC, concessional tax rate of 5% is available. Otherwise not. So the loan must be taken before or before 1st July 2023. Okay. From a source outside India under loan agreement or by way of issue long-term bonds, including long-term infrastructure bonds or by way of issue rupee denoted bond. If an Indian company has issued these bonds and is been subscribed by the non-resident, then the subsequent interest is driving that it shall be taxable at the rate of 5% only. Okay. But the loan must have been obtained on or before 1st July 2023. So there was a sunset of July 2023. If the loan is obtained on or after loan is obtained after 1st July 2023, then the benefit of 194 LC is not available. Okay. Who is required to tax Indian companies or business trust? The borrower. The recipient is non-resident of foreign company. Now the TDS rate. In case of long-term bond or RDB issued after 1st July 2020, but before 1st July 2023, and listed only on Electronic Stock Exchange, the TDS rate is 4%. Okay. If the long-term bond RDB was issued after April 20, but before July 2023, then, and they're listed on Electronic Stock Exchange, IFSC. So they're promoting the IFSC. In such case, the TDS rate shall only be 4%, and you must be understood by now that such incomes shall be taxable in the hands of non-residents at a 4% only. Okay. In any other case, if the units are not listed in a stock exchange or in IFSC or otherwise, then the TDS shall be deducted at the rate of 5%. Any interest other than interest effort to 194 LP and LC is governed by section 195, which is chargeable tax in India. Any person, non-resident, rates imposed. We just discussed. Okay. Tax shall be deducted at the time of credit payment, whichever is earlier. 194 LC is applicable where the loan agreement or long-term bond are approved by the central government. So for concessional rate, the loan agreement or the long-term bond must be approved by the central government. Section 194 LC is applicable only to the extent to which such interest does not exceed the interest amount calculated at the rate prescribed by the approved by the central government. Okay. Tax is deductible at concessional rate of 9% in respect of money borrowed by an Indian company or business trust from a source outside India by way of issue of long-term bonds or RDB on or after 1st January 2023, which is listed only on Electronic Stock Exchange and IFSC. So if the bonds are issued by any person, such bonds are listed on Electronic Stock Exchange and NSE. If the bond were issued on or before 1st July, then they are taxable at the rate of 4%. Otherwise, they are taxable at the rate of 9%. So if the bonds are issued on or after 1st July 2023, then they are taxable at the rate of 9%. Provision section 20688 do not apply to NR or a foreign company deriving income of the nature of interest fee for technical service, royalty, or capital gain if it provides the foreign document. So section 20688 asks for the higher TDS rate if the recipient does not provide a correct PAN to the director. Right? If the recipient of income, if the payee is not providing its PAN, then the payer was under an obligation to deduct the higher rate of TDS or payment being made to them. Okay. However, this provision 20688 shall not apply to NR who is deriving income of the nature of interest, FTS, royalty, or capital gain. So in respect of these income derived by NR, the provision section 20688 is not applicable if the NR provides the following information: name, email ID, contact number, address in the country in which director is a resident, sex agency certificate, test identification number of director in the country of his resident, and if no such number is available, then a unique number allotted to director by the government. So if the NR provides these documents, these details, then the provision section 20688 shall not apply to him in respect of interest, FTS, royalty, or capital gain income. Right? What all the documents he needs to provide, or what all information he needs to provide? He must provide name, email address, and contact number. He must provide the address of his home country, a tax residency certificate, which we call TRC, or lastly, any number as we have PAN, any similar number in the foreign jurisdiction where he is residing. Right? So if you provide these 4 documents, then tax shall not be withheld on payment made to them. Now we will discuss other TDS provision applicable to NA. So first come 196A, income from units of mutual fund. The director may be any person, but the recipient is the owner of foreign company. The mutual fund is required to direct tax at the rate of 40%. Okay. 196B is applicable in respect of section 15AB, the OFO. The income referred to section 15AB. So taxability of income is governed by section 15AB and TDS is given under section 196B. Right. So income from units of mutual fund or units of UTI purchased in foreign currency, all bank account arising from transfer of such units, then tax shall be directed in the hands of on the amount to be paid to the OFO, because 115AB is applicable only to the OFO, as we know. The tax shall be directed at 10% in case of income from units, and if there is a long-term capital gain, the tax shall be directed at 2%. 196C. Income referred to 115AC, income by way of interest or dividend from bonds or GDR for long-term capital gain, then the tax shall be directed at the rate provided in the section. 196D. Interest or dividend income referred to 115AD to the FIA specified fund, or interest or dividend income referred to in such section. Then the FII, if the recipient is FII, the tax shall be directed at the 20%. However, if the recipient is specified fund, then tax shall be directed at the 10%. Now you are connecting the points. There, 115AD was given the taxability of such income in the hands of NR. 196D is giving the TDS rate on the which is required to be complied by the payer. Okay. So 115AD is applicable on the assessee who is receiving the income. 196D is applicable on the payer of income. In both cases, the income is taxable. All the tax is required to be withheld at the rate of 20% or 10% in case of FII or specified one respective. Okay. Tax shall be directed at time of payment or credit, whichever is earlier. Tax shall not be directed in section 196A on any income payable to non-resident Indian or non-resident HUF in respect of units of UTI, where the units has been acquired from the UTI out of the funds in an NRE account maintained with any bank in India, or by remittance of fund in foreign currency, in accordance, in either case, with the provisions of FAM. Okay. Note as section 196D, which is applicable in case of FII or specified fund. No tax on the first section shall be directed in respect of income of specified fund, which is exempt under section 1040. So if income is exempt, then there is no requirement to get tax because it will only result in blockage of fund. Or income by way of capital gain arising from transfer of securities referred to in section 15AD table to FII. Okay. This cover our section TDS rates. So we have discussed the tax rates applicable to non-resident. We have discussed the TDS rates applicable in case of non-resident, means if the P is non-resident, then at what rate tax is required to be withheld, we discussed. Now, a lot of exemptions are provided to non-resident, right? Now we'll discuss that exemptions. Interest on money. So first is section 10.4. It's applicable interest derived by the non-resident in his NRE account. So interest on money standing to the credit of individual in his NRE account with bank in India, if such individual is a person resident outside India as per FAMA. So such person should not be a non-resident as per Income Tax Act, but such person should be a person resident outside India, PROI, as per FAMA, or is a person who has been permitted by the RBI specifically to maintain such account. Then, if he has an NRE account in India and he qualifies to be a PROI, permanent resident outside India, as per FAMA, then the interest so derived from such NRE account shall be exempt. Okay. In case of joint holder, the joint account holder shall be entitled to exemption or sanction or satisfaction above condition by each of such joint account holders. So each of such joint account holders should qualify as person resident outside India as per the family. Then the interest so accrue or so derived from such account. Which account? The NRE account shall be exempt. Second, 10(4)(c). It says that interest payable by an Indian company or business trust to a non-resident or foreign company in respect of money borrowed from a source outside India by way of issue of rupee denominated bond during the period from 17 September to 31st March will be exempt. So a small window was open for the person to subscribe to RDPs issued by the Indian company, and if they subscribe, the interest which they derive from such RDP shall be exempt in their hands. Other assumption aspect of interest are section 1050. So it says, if income is in the nature of interest on deposit made by a foreign bank with a scheduled bank with the approved RBI, so a foreign bank is making a deposit with the Indian bank with the approved RBI, then the interest which is deriving from the Indian bank, which the foreign bank is deriving from the Indian bank, shall be exempt. So bank incorporated outside India and authorized to perform central banking function in that country. Okay. So we are talking about the central banks of the different countries. If they have invested any amount in the scheduled bank of India and they are receiving interest, then such interest shall be exempt in their hands. And section 1015. Okay. So next clause is interest payable by scheduled bank on deposit in foreign currency to acceptance of deposit duly approved by the RBI. Okay. Scheduled bank does not include cooperative bank. So the recipient shall be either be non-resident or individual HUF being a resident but not ordinary residents. Okay. So it's applicable if the assessee is NR or RNOR as the case may be. Next exemption in respect of interest on deposit on or after 1st April 2025 in an offshore banking unit, OBU. Here also the interest derived by the NR or any other individual HUF being a resident but not only a resident shall be exempt. Interest payable by a unit located in IFSC in respect of money borrowed by it on or after 1st September 19. Then such interest shall be exempt in the hands of NR. Now, some exemptions are given in respect of salary income, which become taxable in the hands of NR because the service was rendered in India. Okay. So these exemptions are applicable only if the assessee is not a citizen of India. So first such exemption is remuneration received by officials or staff of embassy. So if there is a embassy in India of a foreign country, then the staff posted there, the officers posted there. So remuneration received by the officials or staff of an embassy, high commission, legation, commission, consulate, or trade representation of foreign state. If the remuneration received by the Indian corresponding government official in such foreign country exempt. So the quid pro quo, you exempt my people from your taxation who are working in my embassy there. I will exempt your people who are working in India in your Indian embassies. Right? So there should be a quid pro quo. Such other countries should also give us a similar benefit. If they don't, then we will also not give the similar benefit to the persons of their country. The above mentioned official staff is not engaged in any other business or profession or employment in India. So they must not be doing any business or profession in India or any other employment in India. They should confine their activity to the embassy only. Remuneration received for service rendered in India as employee of foreign enterprise. So if you are an employee, earlier you were an employee of an embassy, government employee. Now if you are an employee of a private company and you have rendered service in India, thereby making the salary in respect of such services to be taxable in India. The exemption is provided that it says what it says there. The exemption is provided if the company, your employer, the foreign enterprise, is not engaging any business or trade in India. So they are not doing any business or trade in India. The employee's stay in India does not exceed 90 days during the previous year. So an option to stay in India up to 90 days and do the work from here for your employer. Then also the salary of these 90 days shall not be taxable. But if you cross these 90 days, then the entire salary shall be taxable in India. Exemption is only available if you satisfy the condition that your stay in India during the previous year was up to 90 days only. Okay. The remuneration is not liable to be deducted from the employer's income chargeable tax under the Act. So even if your employer has some income which is chargeable in India, the remissions were paid by it to you shall not be allowed the deduction. Okay. So first assumption we discuss about the official who are working in the embassies in India or foreign countries. Now we discuss about the employees of a non-private organization. The threshold is that their stay in India should not be more than 90 days. Next category of salary is salary received by non-resident for service rendered in connection with employment on foreign ship. So if you are working in a foreign ship and you are getting a salary, then if your total stay in India is up to 90 days, the salary you are driving shall be exempt. Where total stay in India does not exceed 90 days during the previous year. Similar to above, okay? Last assumption is to salary is that remuneration received by employees of foreign government. Again, it's applicable to the foreign government employees for their respective government during the stay in India. If such remuneration is received in connection with the training in an establishment or office of or an undertaking owned by. Okay. So if any foreigner has come, any foreign government employee has come, to do a training in any establishment, office, or in any other undertaking owned by the government or owned by the government company and its subsidiary or owned by the statutory corporation or owned by any society which is wholly financed by the government. So if the foreign government employee visit India and visit training in any of these organizations, and what are these organizations? They are government organizations for India. These government companies, then even if service is rendered in India, the salaries received by him shall not be taxable in India. Okay. What it says, Mr. A is a citizen of India but resident of USA since 2012. If he's a citizen of India, then the benefit of Section 10C has lost. Like Section 10(6). Why Section 10(6) has lost? Because it's applicable only in respect of employees who are not a citizen of India. Okay. So if Mr. A is a citizen of India but resident of USA, since the year 2012, he was appointed as a senior official of the US Assembly Embassy in India. Okay. He earned a remuneration of 10 lakhs during financial year 25-26. Being an individual who is a citizen of India, though fulfilling other conditions of the section, such remuneration shall be not be exempt in his under section for the year 2027. So such remuneration shall not be exempt. Why? Because the recipient qualifies to be a citizen of India. The benefit is given only to persons who are not a citizen of India. Okay. Mr. Vikram Kohli, an Indian-born person but currently a resident and citizen of USA. So he is a person of Indian origin but not a citizen. He is a citizen of USA. Again, the benefit of Section 10(6) shall not be available, though he is a Indian-born. So he was appointed as a senior official of US Embassy in India. Okay. He earns a remuneration of 10 lakh during 25-26. Being an individual who is not a citizen of India and also fulfilling other conditions of the section, such remuneration shall be exempt in his hand for 26-27 subject to fulfillment of condition. So clear? Then second last, Mr. Frank D'Souza, an Irish citizen but currently a resident of US. Okay, so he's not a citizen of India. Was appointed senior official of the US Embassy in India. Okay. He earned a remuneration of 10 lakh during 25-26. But his remuneration shall not be taxable if similar benefit was given by the USA to the our people working in our embassy in USA. Okay. Being an individual not a citizen of India, such remuneration shall be exempt in his hands subject to fulfillment of condition. Mr. A citizen of India but resident of USA, since year 2012 was appointed in India in October 2024 as an employee of US enterprise. Such enterprise is not engaged in any business in India. A's job require him to visit US office every 25 days for a reporting purposes. During financial 25-26, Mr. A earned a remuneration of 10 lakh for his India-related arrangement assignment, and his stay in Indian aggregate was 85 days. It's less than 90 days. Further, such US enterprise has not claimed any deduction for such remuneration under the Income Tax Act 1961. So, regarding what indication they are giving, so they are satisfying all the condition of such section. Right? Now, answer is being an individual citizen of India, such remuneration shall not be exempt because you are a citizen of India. However, in the above case, let's consider that Mr. A is citizen of USA. If he is citizen of USA, then the above income shall be exempt. All the facts remain the same. His remuneration shall be exempt from tax in his hand for AY 2027 under this section. Let's take another valuation. If Mr. A is a citizen of US but remuneration paid to him is borne by the PE of such US enterprise in India, then benefit section 10(6) is not available because borne by the employer who is doing a business in India, and such salary is also borne from the Indian PE. Rupees 10 lakh paid to A is a cross charge by the US enterprise to his Indian employment establishment. In this case, the remuneration shall not be exempt from taxation in the hands of Mr. A, as the same is getting deducted from the income of the Indian PE of such foreign enterprise. Clear? Now, there's a concept of IFSC. It runs through the entire act, all chapters. You heard the name of IFSC. Now, there are a lot of income of IFSC which has been exempted from income tax. Why they have been exempted from income tax? Because they earlier were working. Because what the intent to set up IFSC is that to attract the person who are working from Singapore, Malaysia sector. Now, to attract them, we have to do the parity, or we need to be better than the Singapore or Malaysia, and therefore a lot of income of IFSC has been exempted. So, firstly, the income was specified from transfer of certain assets. So, following income accrued arising to or received by specified fund shall be exempt. One is the income from transfer of capital asset being a bond of Indian company or public sector company, GDR or RDB of an Indian company or derivative of any other notified security on a recognized stock exchange located in any IFSC, and where the consideration is paid payment convertible foreign exchange. Any income from transfer of security other than shares in a company resident in India, or any income from securities issued by non-resident and where such income otherwise does not accrue or arise in India, or any income from securitization trust which is chargeable under PGBP. So if there is any of this income, then such income of the specified fund shall be exempt under section 10(4)(d). However, such income, the exemption shall be only to the extent income discussed above. It is attributable to units held by non-resident or is attributable to investment division of offshore banking unit OBU, as a case may be computed in the prescribed manner. Okay. Now, specified fund means a fund established or incorporated in India in the form of a trust of a company or LLP or body corporate, which has been granted a certificate of registration as Category 3 AIF and is regulated under the SEBI. The fund must be incorporated in India in the form of trust, and he has been given certificate of registration as Category 3 AIF and is regulated by SEBI, of course. Alternative National Fund Regulation 2012, made under the SEBI Act 1992, or regulated under the IFSC authority. regulations made under the IFSC Authority Act 2019. Clear? Or a fund which has been granted certificate as retail scheme or an exchange traded fund as satisfy the condition laid down for such scheme of funds under section IFSC regulation made under the IFSC Authority 2019. Or a fund which is located in any IFSC or a fund of which all of the units are held by non-resident other than units held by sponsor or manager. However, this condition will not apply where any unit holder being non-resident during the previous year when such unit or units were issued becomes resident in previous year subsequent to that year if the aggregate value of number of units held by such unit holder do not exceed 5% of total units issued or fulfill such other condition as may be prescribed. 5% is a huge sum. Okay. Now let's understand what do you mean by investment division of OBU overseas banking unit. Investment division means which has been granted certificate of registration as category 1 foreign portfolio investor under SEBI FPI regulation made under the SEBI Act and which has commenced its operation on or before 2030 and fulfills such other condition including maintenance of separate account for investment division as may be prescribed. Next exemption provided to IFSC is in respect of income of non-resident as a result of transfer of non-deliverable forward contract, offshore derivative instrument, over-the-counter derivative entered into with an offshore banking unit of an IFSC. Okay. Which says any income accruing or arising to or received by non-resident as a result of transfer of non-deliverable forward contract or offshore banking unit, offshore derivative instrument, or over-the-counter derivative, or distribution of income of an offshore derivative instrument or over-the-counter derivative enter into with an offshore banking unit of an IFSC as according to section 80 LA or any foreign portfolio investment FPI being a unit of an IFSC. So fulfill prescribed condition would be exempt. Yeah. Now 10(4)(f). It's applicable in respect of income of non-resident by way of royalty or interest on account of lease of aircraft or ship in a previous year paid by a unit of IFSC. The income of a non-resident by way of royalty or interest on account of lease of an aircraft or ship in a previous year paid by a unit of IFSC referred to section 80 LA. The unit had commenced operation on or before 2030. 31st March 2030 would be exempt. Income received by non-resident in an account maintained with an offshore banking unit in any IFSC. So any income received by non-resident from portfolio of securities of financial product or funds managed administered by any portfolio manager on behalf of such non-resident or such activity carried out by such person as may be notified by central government in an account maintained with OBU offshore banking unit in any IFSC as referred in section 80 LA would be exempt to the extent such income accrues or arises outside India. It's not deemed to accrue or arise in India. Then I think the last section comes section 10(4)(h). It's applicable in respect of income by a non-resident or a unit of IFSC. So any income of a non-resident or a unit of IFSC as referred to section 80 LA engaged primarily in the business of leasing of aircraft or ship. So what they give the ship or the aircraft on lease by way of capital gain on transfer of equity share of domestic company being a unit of an IFSC as referred to section 80 LA engaged primarily in the business of lease of aircraft service which has commenced operation on or before 31st March 2020 will be exempt. The exemption from capital gain on transfer of equity share of such domestic companies available for a period of 10 assessment years from AY relevant to the previous year in which domestic company has commenced its operation or from AY 24-25 where the period of 10 assessment year under one above ends before 1st April 2034. Okay, clear? Simple. Another one. Income of foreign company from lease rental of cruise ship received from a specified company. Okay. So any income of foreign company from lease rental by whatever name called of cruise ship received from a specified company which operates a ship or ship in India would be exempt. The income would be exempt where such foreign company and the specified company are subsidiaries of the same holding company, and such income is received or accrued or arises in India for any assessment year on or before 1st April 2030. Scope specified company means any company other than domestic company which operates cruise ship in India and ought to pay tax in accordance with the provision section 44 BBC. Okay. Now, income arising or received by unit holder from specified fund or transfer unit in specified fund. Now we are talking about the taxability of the unit holder of the specified fund. Any income accrued or arising to or received by unit holder from a specified fund or on transfer of unit in specified fund would be exempt. The income is of the nature of capital gain on account of transfer of shares of a company resident in India by the resultant fund or specified fund to the extent attributed to units held by NR in such manner as may prescribe, and such share were transferred from the original fund or from its wholly owned SPV to the resultant fund in relocation, and the capital gain of such shares were not chargeable to tax if that restriction had not taken place. Okay. Income would be exempt only when the specified fund furnishes an annual statement of exempt income in the prescribed form electronically under the digital signature on or before the due date of return of income section 191. Where such form is not filled by the specified fund, the exempt income would be nil. So no exemption. Further, such annual statement, the prescribed form has to be certified by the accountant before the specified date, and such accountant has to furnish by that date the certificate in the prescribed form electronically under digital signature. Okay. The assessee can be the non-resident or a specified fund. Now we are on any income by way of dividend from a company being a unit of any IFSC primarily engaged in the business of leasing of aircraft or a ship. Unit of IFSC engaged in business of leasing of aircraft or a ship. Some exemption provided in respect of royalty income. Because India is a developing country, it needs royalties, it needs the IPRs, the patent, trademark, these licenses, and therefore the benefit is given under section 10. It says tax paid by an Indian company engaged in the business operation of aircraft, which has acquired an aircraft or an aircraft engine on lease under the approved agreement, enter into on lease, rental or income derived, other than payment for providing spares or service in connection with the operation of lease aircraft by the government of foreign state of foreign enterprise. So who shall be this? Government of foreign state or foreign enterprise. Royalty income of fees for technical service under an agreement with the central government for providing services in or outside India in projects connected with security in India. So the foreign company notified by the central government. The assessee, the recipient of income. Now royalty income from or fees from technical service rendered in or outside India through the NTRO, National Technical Research Organization, another government organization. So the interest received by foreign company or non-resident shall be exempt. Lease rental paid by Indian company engaged in the business of operation of aircraft to acquire an aircraft or an aircraft engine on lease, rather than payment for providing spares under a central government approved plan agreement not entered between 1497 and 31st March 1999 or after 31st March 2007. The government of foreign state or foreign enterprise. Now, There are some other exemptions provided with respect to some of the specific entities. So it says certain income of wholly owned subsidiary of Abu Dhabi Investment Authority, sovereign wealth fund, and specified pensions. So it says that any income of specified person in the nature of dividend, interest, any sum referred to section 56 to 12 means any specified sum received by unit holder from the business trust during the previous year with respect to units held by him at any time during the previous year. Or long-term capital gain, whether or not such capital gains are deemed as short-term under section 150. Okay. Arising from investment made by it in India, whether in the form of debt or share capital or unit, would be exempt if such investment is made on or after such opportunity but before 31 March 30 and is held for at least 3 more years. Arising investment should be in the business trust or a company or enterprise or an entity carrying on the business of developing or operating or maintaining or developing, operating and maintaining any fixed facility as defined as mentioned in section 80 4.1 or such other business as notified by the central government in its behalf. Or a category 1 or category 2 AIF regulated under the SEBI attached alternative investment fund regulation 2012 made under section of SEBI Act 1992 having not less than 50% investment in one or more of the company, enterprise, or entity referred to in B or D or E, or an infrastructure investment trust, or a domestic company set up and registered on or after 1/4/2021, having minimum 75% investment in one or more of the company, enterprise, or entities referred to in B, or a non-banking financial company registered by the infrastructure finance company as referred to in notification number RBI this issued by RBI or in infrastructure debt fund or non-banking financial corporation as referred to infrastructure debt fund NBFC issued by the RBI having minimum 90% lending to one or more of the company or enterprise entities referred to in BM. Now some small exemption. Income from of European Union Committee, European Economic Community derive in India from interest, dividend, capital gain from investment out of its fund under notified scheme of the central government. Exemption shall be available to EEC, European Economic Committee. Income of SARC fund for regional projects set up by Colombo Declaration. Income of such SARC fund shall not continue. Income received in India in Indian currency on account of sale of crude oil or any other goods or rendering of service as may be notified by the central government. In this behalf, to any person in India, foreign company and agreement should be notified by the central government national interest. So, it takes in the hands of foreign company on account of sale of crude oil, any other goods or rendering of service, it should not be engaged in any other activity in India. 48A. Income accruing or rising on account of storage of crude oil in a facility in India and sale of crude oil therefrom to any person resident in India, foreign company and agreement should be notified by the central government in national interest. So, if the income of the foreign company on account of storage of crude oil in facility in India and sale of crude oil therefrom. Okay. Now, lastly, the income from sale of leftover stock of crude oil from facilities in India after the expiry of agreement or arrangement referred to in section 1048A or on termination of said agreement or arrangement in accordance with the terms mentioned therein, as the case may be, subject to such condition as may be notified by the central government. Foreign company, the facility shall be foreign company from sale of leftover stock of crude oil from the facility in India. Okay. So these three exemptions were in respect of crude oil. The first two was in respect of European Economic Committee and the SAR. Like, so this complete the exemption also. So today, till now, we have already discussed the tax rates. Then we discussed the TDS provisions. Then we discussed the exemptions. Right? All these are applicable, whatever are applicable to non-resident. Okay. So in tax rates, if you see, What we discussed, we started with 115 AB, which is applicable to OFO in respect to units purchased in foreign currency. Then we move to 115AD, which is applicable in case of FII or specified mutual fund. You with me? Then we discuss what we discuss. Then we discuss about section 115 AC. No. Then we discuss 115 BBA, which is applicable to sportsman or to sports association or to the entertainer. Then we discuss GDA or the foreign currency convertible bond FCCBs, section 15 AC. Then we discussed chapter 2LA applicable to analyze. Then we discuss the TDS, different TDS applicable in case of non-resident. The most important one is section 195. Then we discuss the lot of assumption. First, we discuss general assumption applicable to interest. Then we discuss the assumption applicable in case of salaries. Then we discuss assumption applicable in case of IFSCs. And then we discuss in respect of income from royalty. Lastly, we discuss about the assumption applicable to the wholly owned subsidiary of Abu Dhabi Investment Authority. And lastly, some assumption in respect of European Economic Community or SARC or FUDA. Right? So almost a small 2 or 3 topics are left. Otherwise, our NR chapter is about to get complete. So we'll we'll have a pause for a break of 10 minutes, and then we'll again meet on 7. Okay. Hanji friends. So, welcome back. Now we will discuss whether the activity of eligible fund manager can make the eligible investment fund taxable in India. So, a benefit is given under section 9. It says the presence of eligible fund manager in India not to consume business connection in India of such eligible investment fund on behalf of which he undertakes the fund management activity. So if you are in a foreign fund and your fund manager is doing activity while in India, you have a resident fund manager, then the only basis of such activity of fund manager, you shall not be qualified as a resident in India. So firstly, it says that in the case of eligible investment fund, the fund management activity carried out through an eligible fund manager. So we are talking about an investment fund who has a fund manager. So acting on behalf of such fund shall not constitute business transaction in India said fund. So if the activity of such fund manager shall not constitute BC, business connection of the fund in India, subject to the fulfillment of certain conditions. Okay. Also, an eligible investment fund shall not be said to be resident in India merely because the eligible fund manager undertaking fund management activity on his behalf is located in India. Okay. Only for the reason that the fund manager is located in India, such fund shall not be treated as a resident in India. The eligible investment fund means a fund established. So, who is the eligible investment fund? Means a fund established or incorporated or registered outside India, which collects fund from its member for investing it for their benefit. Okay. For the issue fulfill the following conditions. There are a lot of conditions. If the fund fulfill all these conditions, it's incorporated outside India, then merely for the fact that the fund manager is acting in India, such fund shall not constitute business connection in India, nor such fund shall be treated as a resident in India. So what are all these conditions? So first condition is that fund should not be a person resident in India. So otherwise, the fund should not be a person who is resident in India. Okay. The second condition is that the fund should be a resident of a country with which an agreement, with which a double taxation avoidance agreement has been entered into, or should be established or incorporated or registered outside India in a country notified by the central government. So either the fund is incorporated in a country with which the India has entered into DTL, or it is incorporated in a country which is notified by the central government for this purpose. Now, the aggregate participation or investment in the fund directly by a person being resident in India should not exceed 5% of the corpus of the fund as of 1st April and 1st October of the previous year. So the government will see this condition of 5% twice in a year on 1st April and on 1st October. On both the state, the total investment for the corpus of the fund, which comes from the resident in India, should not exceed 5%. So the member of the fund should be non-resident only. Okay. The resident can be member, but their contribution should not exceed 5%. It says that if the aggregate participation or investment in the fund exceed 5% as of 1st April and 1st October of the previous year, the condition mentioned above will be deemed to be satisfied. So it says that even if it exceeds 5%, we will deem it to be satisfied if the fund reduces aggregate to 5% or less within 4 months from 1st April or 1st October, as a case may be. So firstly, it says that the investment in the fund or corpus of the fund by the person who is resident in India should not exceed 5%. The aggregate of investment. Okay. This threshold shall be seen as on 1st April and 1st October. However, if it breached, then also the government may deem it to be compliant with if the fund reduces the such corpus. Such corpus means corpus of the resident within the coming 4 months. Okay. And while computing this percentage, see what it says. For the purpose of calculation of aggregate participation in the fund, any contribution made by eligible fund manager during first 3 years of operation of the fund not exceeding 25 crores would not be taken into account. So, while computing a percentage, the investment made by the fund manager for the first 3 years, which is up to 25 crores, shall not be taken into account because fund manager must be a resident in India. The fund and its activities should be subject to applicable investor protection regulation in the country or specified territory where it is established or incorporated or is running. The fund should have a minimum of 25 members who are directly or indirectly not connected person. So it says that we are talking about a fund which have at least 25 unconnected members. Okay. Any member of the fund along with connected persons shall not have participation interest directly or indirectly in the fund exceeding 10%. So each member shall not have an interest in the fund for more than 10%. Okay. We need at least 25 members, and each member should not have an interest in the firm for more than 10%. The aggregate participation interest directly or indirectly of 10 or less members, along with the connected person in the fund, shall be less than 50%. So, on individual basis, each member should not have more than 10%, and on any combination of 10 members should not have more than 50% or 50%. The investment should be less than 50%. The investment by the fund in any entity should not exceed 20% of the corpus of the fund. It's not that the fund has invested most of its sum into a one group or one entity. In any one entity, it cannot make an investment for more than 20% of its corpus. And no investment shall be made by the fund in associated entity. Now it says the monthly average of the corpus of the fund shall not be less than rupees 100 crore. Okay. So we're talking about a fund which have at least a corpus of 100 crore. If a fund has been established or incorporated in the previous year, the corpus of fund should not be less than 100 crore at the end of the period of 12 months from the last day of the month as of its establishment or incorporation. Okay. So the monthly average should be at least 100 crores. However, this condition should not be applicable to a fund which has been wound up during the previous year. The fund shall not carry on or control and manage directly or indirectly any business in India. The fund should not be doing any business in India, nor control any business in India. The fund should neither be engaged in any activity which constitutes a business connection in India. The fund should not be doing any activity in India which constitutes business connection, nor should it have any person acting on its behalf whose activity constitutes business connection in India other than the activities undertaken by the eligible fund manager on this behalf. So, separately, we are not talking about the activity undertaken by the eligible fund manager. Other than that, the fund should not constitute business connection in India and should not have any agent in India whose activity may constitute business connection for it. The remuneration paid by the fund to an eligible fund manager in respect of fund management activity undertaken on his behalf should not be less than the amount calculated in the prescribed. Okay. Now it says that the following condition, so if you are a fund of a foreign government, then some of the conditions are not applicable. So it says that the following condition will not be applicable in case of investment fund set up by the government or the central bank of foreign state or sovereign fund or such other fund notified by the central government. What these conditions are? The fund should have a minimum of 25 members who are directly or indirectly not 20%. So in this case, the fund is set up by the government. It will not have a 25 member. It will be the membership will only be the government. So this condition is not applicable. In this case, the member of the fund along with connected person shall not have any participation interest in directly or indirectly in the fund exceeding 10%. Okay. So in this case, the government would have a interest of around 100% only in the fund. This condition that any one person cannot have an interest for more than 10% is also not applicable. Then aggregate participation interest directly or indirectly of 10 or less members along with the collective percent in the fund shall be less than 50%. Even this condition cannot be satisfied in this case. So this condition has become not applicable. Now, eligible fund management in respect of an eligible fund means any person who is engaged in the activity of fund management and fulfills the following condition, which is one, the person should not be an employee of the fund or a connected person of the fund, and the person should be registered as a fund manager or investment advisor in accordance with specified regulations. The person should be acting in the ordinary course of his business as a fund manager. The person along with his connected person shall not be entitled to more than 20% of the profit accruing or arising to the eligible investment fund for the transaction carried out by a fund through such fund manager. Okay. So he should not be entitled to more than 20% of the profit. Now it says that every eligible investment fund shall, in respect of its activity in a financial year, furnish within 90 days from the end of the financial year a statement in the prescribed form to prescribe income tax authority. The statement shall contain information related to fulfillment of above condition and such other relevant information document which may be prescribed. The statement shall state the satisfaction of all of the above condition by the investment fund and the eligible investment manager. If any eligible investment fund fail to furnish such statement or information or document within 90 days from the end of the financial year, if such statement, which is prescribed in section 95, has not been furnished within time specified herein, then the income tax authority may direct that said fund shall pay by way of penalty. Then is a penalty on the fund, which is equal to the amount of its PI flag. Okay. This special taxation regime will not have any impact on tax. Okay. It says that there is a benefit given to the eligible investment fund that even if your manager is sitting in India doing all the activity, you will not be considered as having a business connection in India, nor will be considered as being a resident in India. Okay. But if there was some income which were taxable without even section 9A, then such income shall continue to be taxable. Okay. This special taxation regime will not have any impact on taxability of any income of the eligible investment fund which would have been chargeable to tax, irrespective of whether the activity of eligible investment fund manager constitute business connection in India of such fund only. Okay. So this will not have any impact on the income which would have been chargeable, irrespective of whether the activity of fund manager constitute business connection in India or not. Further, said regime shall not have any effect on the scope of total income or determination of total income in the case of eligible fund manager. Similar to fund set up by the foreign government or sovereign fund, benefit is provided to some of the eligible fund manager where the eligible fund manager is located in IFSC. If such fund manager is located in IFSC as defined in section 80 LA and has commenced its operation on or before 31st March 2030. What are conditions that for eligible investment fund, the following condition will not be applicable. One, the minimum member should be 25. The fund should have minimum 25 members who are directly and indirectly not connected persons. This condition is not applicable where the fund manager is located in IFSC. The second condition same, that any member of the fund along with connected person shall not have any participation interest directly or indirectly in the fund exceeding 10%. And lastly, the aggregate participation interest directly or indirectly of 10 or less members along with the connected person in the fund shall be less than 50%. So as we discussed earlier, these three conditions shall not apply if the fund manager is operating from IFSC. Also, The condition that the fund should not be engaged in any activity, any business in India, nor should control any business in India shall be modified to the fact that it will say that the fund shall not carry on or participate in day-to-day operations of a penny person in India. And for this purpose, monitoring mechanism to protect the investment in such person, including the right to appoint directors or executive directors, shall not be considered as participation in day-to-day operations of such person. Clear? And if the eligible fund manager is working from IFSC, then it says that that manager should be registered as a portfolio manager or investment advisor in accordance with IFSC authority. Okay, so this was all about section 9. Now we'll move to a small section in respect of head office expenditure. We have done all this. Whatever pages we are flipping, we have already done all this in the last class. Now we'll discuss the HO expenses, section 44C. Where it says that whether if there's a branch in India, can it claim the expenses of head office? It says in case of non-resident, head office expenses allowed in accordance with the provision of section 44C. If you are a branch in India, then your income is taxable in India because you contribute P. But P means permanent establishment. But any amount remit to head office, can such amount be claimed as deduction in computing your taxable income? This is known by section 44C. So it says that this section is non-obstante cost, notwithstanding cost, and anything contrary contained in this section, in any other section, is not applicable. So this section applies over and above all other sections. Deduction in respect of head office expenditure is restricted to the following. So it says that deduction in respect of HO expenditure cannot exceed the following amount. First amount is that the amount equal to 5% of adjusted total income, ATI, or in case adjusted total income is a loss, then 5% of average adjusted total income. Okay. Or the amount of so much of the expenditure in the nature of HO, head office expenditure, incurred by assessee as is attributed to the business profession of the assessee. So similar law that whatever amount reimbursed to HO can be allowed only if it is attributable to the business of assessee in India. Okay. Even in that case, the amount cannot exceed 5% of adjusted total income. And if the adjusted total income is a loss, then cannot exceed 5% of average of adjusted total income. What do you mean by adjusted total income? Means total income computed in accordance with the provisions of this act without giving effect to this HO expenses allowed under this section. Unabsorbed appreciation, family planning expenditure unabsorbed, business loss brought forward under section 72, speculative loss brought forward, capital gain loss from certain specified source brought forward, and lastly, deduction chapter 6. So without giving effect of all these provisions, of all these sections, the amount of income for computed is called adjusted total income. And 5% of this adjusted total income is the maximum limit by which HO expense can be allowed. How in case of loss, we have to see the average of adjusted total income. Then how the average is computed? Average computed for the last 3 years. How if the branch was there for less than last 3 years, for less than 3 years, then we will compute the average for the period branch is there. See how is it written? The total income of assessee assessable for each of the 3 assessment year immediately preceding the relevant previous year assessment year. 1/3 of the aggregate amount of adjusted total income in respect of previous years relevant to the aforesaid 3 assessment year is the average. So we will take the average of the last three assessment years. However, the total income was assessable only for two of the aforesaid three assessment year. So I was taxable only for the last 2 years. Then one half of the aggregate, I will do the average of these 2 years only. So one half of the aggregate amount of the adjusted total income in respect of previous years relevant to the aforesaid two assessment years is taken on average adjusted total income. Clear? So when the total income assessment only for one of the assessment year referred above, the amount of adjusted total income in respect of previous year relevant to that assessment is average adjusted total income. Okay. So firstly, you will take the adjusted total income for the current year. However, if there's a loss in the current year, then you can go backward up to 3 years. Okay. So then you will see the average adjusted total income, which is the average of the last 3 years adjusted total income. Or if the branch was there for less than 3 years, then if the branch was there for 2 years, the average adjusted total income is the average of the last 2 years adjusted total income. If the branch was there only for 1 year, then the adjusted total income of that year shall be treated as the average adjusted total income for this section. And 5% of this amount is a maximum amount for which, by which, up to which you can claim deduction under section 44C in respect of actual expense. See, a small illustration for you. It says the net result of business carried on by branch of foreign company in India for the year ending 31st March 2026 was a loss of 100 lakh after charge of actual expenses 200 lakh allocated to the branch. Explain with reason the income of to be declared by the branch in its return for assessment of 26-27. It says that the branch has shown a loss of 100 crore, but while computing this 100 lakh, means 1 crore, actual expense of 2 crore has been debited. So section 44 says that first I have to compute the adjusted total income. For computing adjusted total income, I have to exclude actual expenses. So I have a loss of 100 crore, 1 crore. And while computing this 1 crore loss, I have already deducted 2 crore, which I should not have done. So I add it. So my adjusted total income is 1 CR positive. And the maximum actual expense which can be allowed is 5% of 1 CR, which is 5 lakh, or 200 lakh, whichever is less, so 5 lakh. So my income taxable in India is section 95 law. So it says 100 lakh is the loss. I'll add 200 lakh on account of actual expenses already deducted. So I got an income of 100 lakh. Now the actual expenses can be allowed 5% of this 100 lakh, which is 5 lakh, or actual expense 200 lakh, whichever is lower. So I will allow 5 lakh only, and the income shall become 95 lakh. So 100 lakh loss has been converted into an income of 95 lakh. Okay. This we have all done. Now we'll do some miscellaneous provisions, like conversion of branch of a foreign bank into a subsidiary company of such foreign bank. Something like that. See, it comes. Special provision led to conversion of Indian branch of foreign bank into a subsidiary company. So see, there's a foreign bank. There's a branch in India. Now, such foreign bank is converting such branch into a subsidiary, wholly owned subsidiary. Then it says that the provision of this section shall apply to a foreign bank, foreign company engaged in banking business, meaning foreign bank, through its engaged in banking business in India through its branch situated in India, which is converted into Indian subsidiary in accordance with the scheme framed by the RBI. If the condition notified by the central government is behalf satisfied, then capital gain arising from such conversion will not be chargeable to tax in the assessment year relevant to the previous year if such conversion takes place. So on conversion of a branch to a company, whatever the capital gain arised, such capital gain shall not be taxable. How such capital gain shall be exempt or shall not be taxable if the Indian branch amalgamates with the Indian subsidiary in accordance with the scheme of amalgamation approved by the shareholder of foreign company and Indian subsidiary and sanctioned by the RBI. All assets and liability of Indian branch immediately before conversion would become the assets and liability of the company, subsidiary company. The assets and liability of the Indian branch are transferred to the Indian subsidiary at values appearing in the books of account of the Indian branch immediately before its conversion. So all assets and liability of the branch and the values at which they were recorded in the branch are being transferred to the company, and the company shall also record the value, which were the value in the book of the branch. The foreign bank or its nominee shall hold the whole of the share capital. So there is no entry of a third person. So earlier also the branch was wholly under the control owned by the foreign company. Now this, even though they have formed a separate legal company, but the whole of the share capital shall be held by such foreign company, foreign bank only. So foreign bank shall hold whole of the share capital of Indian bank, Indian subsidiary company, during the period beginning from the date of conversion and ending on the last day of the previous year in which the conversion took place, and continue to hold the shares of Indian subsidiary carrying not less than 51% of the voting power for a period of 5 years immediately succeeding the said previous year. Okay, so firstly it says that the whole of the share capital of the subsidiary should be held by the foreign bank or its nominees. Okay. The foreign company does not receive any consideration or benefit directly or indirectly in any form or manner other than by way of allotment shown in the Indian subsidiary account. Now, what we mean by allowance and appreciation in section 32 means so much of the allowance which remains unutilized. Okay. And we also refer to the depreciation for the year in which this conversion took place. So it says that the aggregate deduction in respect of depreciation allowable to Indian branch and to the subsidiary. So there is a conversion in the middle of the year. So the aggregate depreciation which is allowed to the branch and to the company, this aggregate shall not exceed in any previous year the deduction calculated at prescribed rate as if the conversion had not. As if the conversion had not happened, then what would be the amount of depreciation? That such amount shall be the upper limit. Okay. The aggregate depreciation claimed by the branch and the company in the same year shall not exceed the depreciation amount which would have been allowed had this conversion not taken place, which would have been allowed to the branch had this conversion not taken place. Such action would be appropriate proportion between the Indian branch and the Indian subsidiary company in the ratio of number of days for which the asset was used by that. Okay. So we will compute the depreciation for the entire year as a single assessee, and such amount shall be proportionate between the branch and the company on the basis of the number of days for which the asset was used by each of them. Okay. Set off and carry forward loss and depreciation. So it says that accumulated loss and another depreciation of Indian branch would be deemed to be the loss. Such loss shall not lapse. It is being given a life in the hands of company. So such loss or depreciation shall be deemed to be the loss or allowance of depreciation of Indian subsidiary company for the previous year in which conversion took place. And provision of the Act relating to set off and carry forward shall apply accordingly. Actual cost means actual cost of the asset acquired by the company from this conversion. Of course, if the conversion is tax neutral, then the actual cost in the hands of the company shall be same as actual cost in the hands of the branch. So it says that the actual cost of block of the asset in case of Indian subsidiary shall be WDV of the block, as in the case of Indian branch on the date of its conversion into Indian subsidiary. So on the date of the conversion, whatever the value at which the asset were held by the subsidiary shall be the value at which the asset will be taken over by the company. The actual cost of any capital asset on which deduction has been allowed under Section 35 AD or is allowable under Section 35 AD. The actual cost such as shall be taken to be nil in case of Indian subsidiary company. If the capital asset became the property of Indian subsidiary company as a result of conversion of Indian branch. So if there is any asset which is in respect of which there is a Section 35 AD loss, the entire deduction, then the actual cost of such asset shall be taken to be the nil. Cost of acquisition of other assets shall be same as in the hands of the branch. It says that where the capital asset other than those referred to in C above became the property of the Indian subsidiary as a result of conversion of Indian branch, the cost of acquisition of the asset for the purpose of computation of capital gain shall be deemed to be the cost for which the Indian branch acquired it, or as the case may be, the cost for which the previous owner has acquired. So whatever the cost would be there in the hands of branch, the same cost shall be there shall be for the subsidiary company. Tax credit. So any tax credit which was there which was lying unutilized in the hands of the branch shall become unutilized for the company. Now the subsidiary company can take the benefit of such brought forward such tax credits. The tax credit of Indian branch shall be deemed to be a tax credit of subsidiary company for the purpose of previous year in which conversion has effected. And the provision section 115JAA, the MAT credit or the AMT credit shall apply accordingly. Amortization of VRS expenditure. The provision section 35DDA Act of the Act shall be, as far as may be, applied to the Indian subsidiary company as they would have been applied to the Indian branch if the conversion had not taken place. All those benefits which were there for the Indian branch has been transferred to the company. So what the law assumes, there is nothing has been changed. It's only the conversion from a branch to the company. Otherwise, there is nothing has been changed and nothing should be changed. On the basis that nothing has been changed, an exemption is provided in Section 10. Deemed capital balance. Deemed credit balance in provision for bad and doubtful debts. The credit balance in the provision for bad and doubtful debt account made under Section 3617A of the Indian branch on the date of conversion shall be deemed to be the credit balance of the Indian subsidiary company. And provision section 36 of the Income Tax Act shall apply accordingly. Non-applicability of section 56 to 10. The provision section 56 to 10 shall not apply to the transaction of receipt or shares in Indian subsidiary company by the foreign company or its nominee in consequence of the conversion of Indian branch into Indian subsidiary company. If the conditions specified in the scheme of RBI notification issued by central government are not complied with, then all the provisions of the Act will apply for the foreign company and the subsidiary company without any benefit. Okay. So these are that this conversion has been approved by the scheme, approved by the RBI. So such scheme had some condition. And if such condition has not been complied with, then the benefit of income tax of capital gain exemption conversion shall not be applied. Now we discussed that the foreign company should hold the whole of the share capital of the subsidiary company even after the conversion, right? But if there is subsequent failure, then what will happen? It says that if benefit exemption relief has been granted to the company or to the foreign company or the Indian subsidiary company in any previous year, and thereafter there is a failure to comply with any of the conditions specified in the scheme or notification, then such benefit exemption relief shall be deemed to have been wrongly claimed. Shall be deemed to have been wrongly claimed. Okay? If there is a failure to comply with the conditions specified in the scheme. In such a case, the AO is empowered to recompute the total income of assessee for said previous year and make the necessary amendment. Previous year in which this condition are not complied. This power is notwithstanding anything contained there. This overrules the entire Act. The provision of rectification in section 154 will accordingly apply because now the exemption has to be withdrawn and the 4-year period within which such rectification should be made has to be exercised, has to be reckoned from the end of the previous year in which failure to comply with such condition has taken place. So in this time, the AO can pass rectification order and withdraw the exemption. This previous provision we have done. Now we are left with very small miscellaneous topics regarding recovery of income tax. See, I'll show you. Yeah. Recovery of tax in respect of non-resident. So if there is any sum required to be recovered from a non-resident, then the Act says, firstly, you get it recovered from the assets in India or which may come in India in the name of non-resident. And if such asset is not sufficient to meet the amount of liability, then the TRO may write to CBDT and CBDT may can do whatever it fits like. So it says that in case of NR, any area of tax may be recovered also in accordance with the provision of Income Tax Act from any assets of the NR which are or may at any time come within India. Okay, if there is some asset in India of the NR, then such amount can be recovered from such assets, or it can be recovered from any future asset which may come into India. Right? The recovery can also be made from SSC's property in a foreign country. But this is not so simple. Here, what will happen? The SSC is in default is deemed to be default making payment of tax. The TRO, tax recovery officer, may, if the SSC is a resident of a country with which we have a double taxation avoidance agreement, or such person has any property in that country, then the TRO may forward to the CBDT a certificate drawn by him under section 222, which have a entire details of recovery. Thereafter, CBDT may take such action thereon as it deem appropriate, having regard to the terms of the agreement with such country. So whether to oppose such country or not has to be decided by the CBDT. Similarly, the government of other country. So there is some amount which is payable by Indian resident to the government of any foreign country. Then such foreign country can also write to the India and ensure that the assets in India are, to the extent of the liability, are being handed over to this person. It says that similarly, the government of other country or other authority under the government may send to the CBDT a certificate of recovery of any tax due under such corresponding law from a person having property in India, and CBDT may forward the certificate of TRO having jurisdiction over the resident or within whose jurisdiction such property is situated for the recovery of such tax. TRO can proceed to recover the amount specified in the certificate by the attachment and sale of the assessee movable property, by the arrest of the assessee and his detention prison, or by appointing a receiver from the management for the management of assessee's movable and property. She shall thereafter remit the sums received to CBDT. The license office is required to furnish a statement with the income tax authority, the annual information statement. It says that such non-resident having a license office is required to file a statement in the prescribed form 49C, to AO having jurisdiction within 8 months from the end of such financial year. A statement pointing details in respect of activities carried out by the license office in India during the financial year. So the report should contain the activities which are undertaken by the license office in India. One wants to understand this. Why? Because it needs to understand whether the activities are exceeding the activity for which the license office was given a permission as per the RBI. Now, in case of Indian concern also, it's required to furnish a statement, a report to the income tax authority. This information should be furnished in Form 49T electronically within a period of 90 days from the end of the financial year in which transfer of shares or interest referred to above take place. So above is regarding Vodafone transaction. Amendment made consequence to Vodafone transaction, which we discussed yesterday. However, if the shares or the interest has the effect of directly or indirectly transferring the right of management or control in relation to the Indian concern, the information should be furnished within 290 only. But then the time limit shall be 90 days. But now here from the date of transaction, and it was from the end of the financial year. Okay. If any Indian concern fail to furnish the information, then there is a penalty. Then the income tax authority, as may prescribe under the subsection, may direct that such person shall pay by way of penalty of 2% or sum equivalent to 2% of the value of the transaction in respect of which such failure has taken place. If such transaction had the effect of directly or indirectly transferring the right of management or control in relation to the Indian concern, of 5 lakh in any other case. Agent of a non-resident, representative assessor. Okay, section 163. It says, in relation to a non-resident person, an agent in relation to a non-resident person includes any person in India who is employed by on behalf of such NR, who is having any business connection with the NR, from or through whom the NR is in receipt of any income, whether directly or indirectly, or who is trustee of the NR. And any other person, whether resident or non-resident, okay, has acquired a capital asset in India by means of transfer from the notes. If you have acquired any capital asset in India from such non-resident, then also you can be treated as agent of such non-resident. The buyer non-resident can be treated as an agent of seller non-resident. However, before treating any person as an agent of the NR, an apology of being is required to be given. So this completes our chapter NR. Now we'll move to next chapter, double taxation avoidance agreement. So it says, where taxpayer is a resident on one country but has a source of income situated in another country. So if you are an Indian resident but you have an income from US also, then this gives rise to a possible double taxation. Why double taxation? Because since the income is arising in US will tax it on source basis, and India will also tax it because it's derived by a resident of India. And for in this case, in case of resident, the global income is taxable. So India is also taxing the income derived from US, and US also driving income is also taxing this income. US taxing on the basis of source rules, India is taxing on the basis of residence rules. Okay. This arises from the two basic rules that enable the country of residence as well as the country where the source of income is fixed to impose tax, namely the source rules and the residence rule. Now, to solve this double taxation problem, double taxation avoidance agreement have been signed by India with many countries. Now, this DTL lays down the allocation rule for taxation of income by source country and the resident country. So, what DTL says that they allocate the income between the source and the resident country. They said this income shall be taxable in the source country, this income shall be taxable in resident country. It may also say clearly that this income shall be taxable in both the cases. Okay. Double taxation means that taxing the same income twice in the hands of same assessor. Now, relief. There are two types of relief, bilateral and unilateral. Bilateral means with the consent of both the parties. Unilateral means I decide myself. Okay. So in case of bilateral relief, under this method, the government of two countries can enter into an agreement to provide relief against double taxation by mutually working out the basis on which relief is to be granted. Okay. So both the country decide. Now bilateral relief can also be divided into two parts. The relief can be provided either through exemption or through credit. There is a one exemption method and there is a tax credit method. Exemption method means a particular income is taxed in only one of the two countries and it is exempted in the other country. There is no double taxation. If this income, if the US and India agrees to the fact that this income will either be taxed in India only or in US only, then there is no double taxation. In case of credit method, what is that? Which is more important, most of my Indian treaties are on credit method. It says that income is taxable in both countries in accordance with their respective tax laws and double taxation. What is happening? In case of tax method, the tax is levied by both the countries. However, the country of residence of the taxpayer allows him credit of tax charged there in the country of source. Then double taxation is get relief by the fact that the resident country gives credit of the taxes paid on this income, on this double taxation income outside India. India follows credit method in majority of its DTL taxation. Unilateral relief. Unilateral relief means on its own, without consulting with the counterparty. So it says that this method provides for double taxation relief unilaterally by a country of its resident, by a country to its resident for taxes paid in the other country, even where no DTAA has been entered into with that country. Okay. Now, the power to enter into double taxation what is agreement is given by Section 1998 to the central government. It says Section 90 empowers the central government to enter into an agreement with foreign country or specified territory outside India, while Section 90 empowers the central government to make provision for adopting and implementing of any agreement entered into by any specified association in India with any specified association outside India. Objective, most important. The objective of Section 1998 is for granting relief in respect of income on which income tax has been paid both in India and in that country. So, to grant relief in respect of double tax income. So, to grant relief in respect of income tax chargeable under the Act, under this Act, and under the corresponding law in force in that country. To promote mutual economic relation, trade, and investment. For the avoidance of double taxation of income under this Act and under the corresponding law in force in that country, without creating opportunities. Another option is, another objective is to avoid double taxation, but such avoidance should not create opportunity for non-taxation or reduced taxation through tax evasion. So what is the problem? That both the countries are taxing, but the provision of DTAA should not create any opportunity that none of this country is taxing. Okay? Without getting any opportunity for non-taxation, there should be at least one taxation. We don't want double taxation, but at the same time, we don't want no taxation. We mean the government. Without getting opportunity for non-taxation due taxation through tax evasion or avoidance, including through treaty shopping, or for exchange of information for the prevention of evasion or avoidance of income tax chargeable under this Act, or under the corresponding law in force in that country or specified territory, or investigation of cases of such evasion or avoidance. And lastly, for recovery of income tax under this Act or under the corresponding law in force in the country of in that country or specified territory. When the agreement has been entered through the Section 90 for granting a relief of tax or avoidance of double taxation, then in relation to the assessee to whom such agreement applies, the provision of this Act, domestic law, shall apply to the extent they are more beneficial to that assessee. So there's a DTAA, then the provision of DTAA or the act which is more beneficial shall apply to the assessee. However, provision chapter 10A, that is GAR, General Anti-Avoidance Rule, shall apply to the assessee even if such provisions are not beneficial to. Of course, GAR provisions are not beneficial, they are counter provisions. The charge of tax in respect of foreign company at a rate higher than the rate at which a domestic company is chargeable shall not be regarded as a less favorable charge or levy of tax in respect of such company. So it says that if a foreign company has been taxable at a rate higher than the rate applicable to domestic company, then the merely this fact shall not be considered, shall not be regarded as a less favorable treatment to such foreign company. Now it says that any term used in any agreement which is not defined in the any agreement with any DTAA, which is not neither defined in the act nor in such agreement. But then such words shall have the such terms shall have the same meaning as assigned to it in the notification by the central government in this behalf, unless the context otherwise required is not inconsistent with the provision of the act or the act. Accordingly, the central government has bring out a notification, and in this notification, it has been notified that when agreement under Section 90 or 90A provides that any income of a resident of India may be taxed in the other country. So the word is used may be taxed, but not a shall tax. It provides that the income may be taxed in the foreign country, then such income shall be included in the total income chargeable tax in India also, because it's the word may. So both India and the foreign country can tax it in accordance with the Act, and relief shall be granted in accordance with the method of elimination or avoidance of double taxation provided in such agreement. Meaning of the terms used in the agreement. See, if there is any term in the agreement and it is not defined in the agreement nor in the Act, but assigned has been defined in a notification issued by the central government. Okay. The meaning of such term shall have the same meaning assigned in the said notification, and the meaning shall be deemed to have effect from the date on which the agreement came into force, or retrospectively. Even the notification has recently been issued, but the definition of any term used given in such notification shall apply from the date the agreement was entered into. Okay. The term used in any agreement which is defined in the agreement itself. So the meaning of such term shall be as per the meaning so defined in the agreement. The term shall have the same meaning assigned to it in the agreement. Term used in any agreement which is not defined in the said agreement but defined in the income tax act. Then the term shall have the meaning assigned to it in the act and explanation, if any, given to it by the central government. Okay. Now it says that if there is any person who is taking a treaty benefit to whom the provision of section 90 is applicable, then treaty benefit shall be allowed if a TRC, tax revenue certificate, obtained by him from the government of that country or specified territory is furnished declaring residence of any of the country outside India or the specified territory outside India, as the case may be. Okay. So TRC, tax revenue certificate, is very mandatory to claim treaty benefit. So an NR is required to furnish the following document to claim a treaty benefit. First, he has to state his status, whether he is operating as an individual, firm, company, his nationality in case of individual, assesses tax identification number in the country or specified territory of residence, and in case of no such number, then a unique number on the basis of which the person identified by the government of the country of which the assessee claims to be resident. Period for residential status and mentioned certificate referred to in section 90 is applicable. And address of the assessee in the country of his residence for the certificate mentioned for it is applicable. So NR is required to give all the details to claim the treaty benefit. However, if any such details are already stated in TRC, the same is now required to be given separately. So it says that the assessee may not be required to provide the information on any part thereof. If the information of part thereof as the case may be already contained the TRC, refer to in section 94 or 90A4. Now see the illustration. It says that it asks that you have to examine the correctness or otherwise of the following statement with reference to the provision of the Act. The double taxation avoidance treaties entered into by the government of India override the domestic law. The answer is, the question is whether the DTAA entered into by the government of India override the law, domestic law. Then yes. So assessee has an option to opt for the provision of DTAA or the Act whichever is more beneficial to it. The statement is correct. Now we're talking about section 91, that is country with which India does not have DTAA. Okay. The relief under section 91 is applicable if the following conditions are satisfied. One, the assessee is a resident in India during the previous year in respect of which the income is taxable. Okay. The income accrue rise to him outside India. Okay. The income is not deemed to accrue rise in him in India. Okay. The income in question has been subject to income tax in foreign country in the hands of the assessee. The assessee has paid tax on the income in that foreign country. There is no agreement for relief from double taxation between India and that foreign country where the income has accrued. So there is no double. Okay. So what it's saying that the person is resident in India and is a deriving income from outside India, which have been subject to tax in such country. Now, in such a case, the assessee shall be entitled to a deduction from the Indian income tax payable by him. If this FTC, foreign tax credit, shall be available from the Indian income tax payable by the assessee. The deduction would be a sum calculated on such doubly taxed income at Indian rate of tax or the rate of tax in the said country, whichever is lower, or at Indian rate of tax if both rate is equal. What we will do, we will compute the Indian rate of tax, we will compute the rate of tax applicable in the foreign country, and whichever is lowest, we'll apply that rate to the doubly taxed income, and we'll come to the amount of foreign tax credit which is to be reduced from the tax payable by the assessor. See, let's understand this with the help of an example. It says that Nandita, an individual resident retired employee of Prasar Bharati, a 16-year, is a well-known dramatist driving income of 1,10,000 from theatrical work late abroad. So she is resident in India, but she has earned an income of 1,10,000 from abroad. Tax of 11,000 was rated in the country where the plays were performed. So the country where the plays were performed had deducted tax of 11,000 means 10%. 10% of 11,000, 10% of 1,10,000. India does not have any DTAA under section 90 with that country. So this is a case of section 91 because in this case, the India does not have DTAA with the country. Her income in India would be 6,10,000. Her Indian income is 6,10,000 and foreign income is 1,11,000. Okay. In view of tax planning, she had deposited 1,50,000 in PPF and paid contribution to approved pension fund of LIC 32,000. She also contributed 28,000 to central government health scheme during the previous year and gave payment of medical insurance premium 26,000 to ensure the health of her mother and a non-resident aged 84 years who is not dependent on her. From the tax liability Nandita for year 26-27, assuming that she opt out of default tax regime. So we are talking about the Indian tax, old tax regime. Okay. This is my Indian income 6,10,000. This is the income which I derive from outside India 1,10,000. Now I have deposited 1,50,000 in PPF and I have also contributed to approved pension fund 30,000. So total deduction is 1,82,000, but it will be restricted to 1,50,000. Now we have 80D, the premiums, 28,000, 25,000 simple. So total deduction comes at 2,03,000. Now there is a total income of 5,17,000. Now I come to a tax of 5,17,000. 1,400. This comes very simple. This is the old regime. Now average rate of tax in India is this tax divided by the income. So it comes 1,693 income. It becomes 2.696% only. And however, the average tax in the foreign country was 10% because it received a royalty of 1,10,000 on which 11,000 TDS were deducted. Okay. So the lowest is 2.696. And apply this lower amount to the double tax income, which is this 1,10,000. And the amount for right shall be allowed as a deduction. The amount comes as 2,966 and net payable is 1,0970. Now foreign tax credit. Similar to TDS, it shall be allowed in the year in the hands of the person who has shown the income, corresponding income, and in the year in which such income has been shown. If such income has been shown in a spread of more than 1 year, then the credit should also be spread in the same ratio. Okay. So it says that an assessee being a resident shall be allowed a credit for the amount of any foreign tax paid by him in a country outside India by way of deduction or otherwise in the year in which income corresponding to such tax has been offered to tax or assessed to tax in India. However, in a case where income on which foreign tax has been paid or deducted is offered to tax in more than 1 year, credit of foreign tax shall be allowed across those years in the same proportion in which the income is offered tax or assessed to tax in the India. Now it says that FTC, foreign tax credit, is available against the amount of tax, surcharge, and cess, of course. How it's not available against interest or penalties. Clear. Logical. The FTC credit should be lower than the tax payable under Normal Provision Act on such income and foreign tax paid on such income. P. Concept of P. So similar to business connection which we have in domestic law, under DDAA we have a concept of permanent establishment P. The scope of business connection is more wider than P. And now we know that there's an option to choose between the act and the treaty, whichever is more beneficial. Right? So if there's a P, the definition of P is restricted to the DAA, then I will always go for the P because there are chances that a P may not constitute, but there are chances, high chances that business connection may constitute. So the P is restricted, the definition of P is restricted as compared to the business connection. Okay. So if you have an agreement, you will choose whether you see whether you have P or not. If the answer is no, then nothing taxable. If yes, then it is taxable. Okay. It may be if you don't have an agreement, then the concept of P does not arise. We will have to see whether you constitute a business connection or not. So it says that it may be noted that scope of business connection under Section 9 is wider than that of P. As I told you, the term PE, permanent establishment, means a fixed place of business through which the business of an enterprise wholly or partly carried out. Okay. These are some different types of P which has been there in the almost every DTAA. A place of management is called a P. A branch is P. An office is P. You understand why we are discussing a lot about P? Because if the foreign enterprise has a P in India, then the income attributable to that P is taxable in India. A factory is also a P. A workshop. These all are for the foreign companies. A sales outlet, a warehouse, a mine, oil and gas valley, well, all these things are a part of P. No license office. So what are license office? License office are only there to as a communication channel. They don't do any other activity. Their activity are held to be very auxiliary. So what they do is that they only act as a communication channel between the foreign parent and the India. Right. But this is as per paper. Actually, they are doing So if they are doing only this much, they will not constitute a P. So if leather office is only acting as a communication channel, then it will not constitute P. However, identifying new customer, marketing activities, price negotiation, discussion of commercial issues, securing and processing orders have led to the license office forming a P. Even if you are license office, you will be considered a P. You are doing actually business in India. It's not the fact that you are only acting as a communication channel. Now, business process outsourcing, BPO. The question is whether they will qualify as a P or not. So it says a non-resident entity may outsource certain service to resident Indian entity. If there is no business connection between the two, the resident entity may not be a PE of the non-resident entity. And the resident entity would have to be assessed to income tax as a separate entity. In such a case, the non-resident entity will not be liable under the income tax act. The non-resident entity of the foreign company will be liable to tax in India only if IT-enabled BPO unit in India constitutes its P. If the foreign company has outsourced some of the activities to India, then it shall be deemed that it has a P. If it has a P in India, if such activity constitutes a P of such foreign company, then it will be taxable in India, of course. A non-resident of foreign company treated as having a P. Now, when we can say that the non-resident has a P in India, if the said non-resident of foreign company carries on business in India through branch, so the business is being carried out in India, then the P is there. And if such business through, doesn't matter whether it is through branch or sale office or through an agent who actually habitually exercise the authority to conclude contracts or regularize, deliver goods or services, goods or merchandise, or habitually secure orders on behalf of the non-resident principal. In such a case, the profit of non-resident or foreign company attributable to the business activity carried out in India by the PE becomes taxable in India. If a foreign company carries on business in another country through a PE situated therein, the profits of the enterprise may be taxed in the other country, but only so much of the profit as is attributable to the PE. Profits are to be attributed to the PE as if it were a distinct and separate enterprise engaged in the same or similar activities and the same or similar condition dealing wholly independent with the enterprise of which it is a PE. In determining the profit of a PE, there shall be allowed as deduction expenses which are incurred for the purpose of PE, including executive and general administrative expenses for incurred, whether in the state in which PE is situated or not. So, if there is a PE, thus income of PE is computed on net basis after allowing expenses incurred for the purpose of PE. The profit to be attributed to PE are those which the PE would have made it. So, how you compute the arm's length price? It says that the profit shall be the same which the P would have made if instead of dealing with the HO, it had been dealing entirely with a third person, separate enterprise under condition and at prices prevailing in the ordinary market. This corresponds to the arm's length price. Okay. So a small chapter. DTL. So let's see some small questions. It says that Cosmos Limited, a company incorporated in Mauritius, has a branch office in Hyderabad. Okay. Opened in April 2025. So the Mauritius company NR has a branch in Mumbai, Hyderabad. The Indian branch has filed return of income for AY 2027 disclosing income of 50 lakh. Okay. So Indian branch in the P has disclosed an income of 50 lakh. Input tax at the rate applicable to domestic company, 30% plus higher tax. Higher education tax of 4% on the basis of paragraph 2 of Article 24, non-discriminatory of global taxation what is agreement between India and Mauritius, which read as follows. So there is a 24.2 Act para which states that the taxation of P, the branch is a P, which an enterprise of a contracting state has in India shall not be less favorably levied in India than the taxation levied on enterprise of that enterprise that is the state carrying on same activity in the same circumstances. However, the AO computed tax on the Indian branch at the rate applicable to foreign companies of 35% plus higher sales of 4%. So is the action of AO in accordance with law? Answer is yes, because Section 90 says that taxing a foreign company at a higher rate doesn't come within the definition of discrimination. Let's see second question. It says that Kalpesh Kumar as an individual is a musician driving income of 750,000 from concert performed outside India. So this is foreign income. Tax of 1 lakh was reduced at source in the country where the concert was performed. So 1 lakh has already been paid in the foreign country. So this is foreign tax. India does not have any double taxation about its agreement with that country. So we don't have an agreement, so relief can be availed only under Section 91. His income in India amounted to 30 lakh. So his Indian income is 30 lakh and foreign income is 750,000. Compute net tax liability of Kapesh for assessment 2677, assuming he has deposited 1,50,000 PPF and paid medical insurance premium in respect of his father resident in India, age 65 for 52,000. Okay. So what is the income? The income is 30 lakh plus 7,50,000, 37,50,000. From this income, I will do the deduction. If we have opt for, assuming we have opt out of the, if we have not opt out, then there is no deduction shall be available. Okay. Then this 37,50,000, I will compute a tax. I will come to the percentage. Then I have the percentage of foreign country percentage at which the foreign company levies tax. So whatever is the lower, we'll take that and apply that rate to the doubly tax income. See, it says Indian income and the foreign income total income 3,75,000, 37,50,000. Deductions are not allowed. I'll compute a tax on this, which comes to 7,37,200. Now the percentage of Indian tax is this divided by 37,50,000, which comes to 19.552%. And the foreign country has withheld tax of rupees 1 lakh on 750,000. So they have deducted tax at the rate of 13%. So I'll give the FTC lower of these two rates, which is 13.33%. So whatever is the double tax income is 750,000. I apply this rate on this income to the assumption the FTC comes at 1 lakh. And I have to pay 6,33,200. Clear? Now question 5. Simple questions. An individual resident in India having income earned outside India in a country with which no agreement of the Section 90 exists. Asked you to examine whether the credit for tax paid on foreign income will be allowed against his income tax liability in India. Of course, answer is yes. He shall be allowed the FTC because under Section 91, even if there is no double taxation, what is happening? The Income Tax Act, next question, provide for taxation of certain income earned in India by Mr. X, a non-resident. Okay. DTAA, which applies to Mr. X, provide for taxation of such income in the country of residence only. Is Mr. X liable to pay tax on such income earned by him in India? Answer is no. Why? Because treaty provision or the provision that which are more beneficial to him shall apply. So here the domestic law becomes more beneficial because domestic law says that such income shall not be. The DTAA becomes more beneficial because DTAA says that such income shall not be taxable in India. These are two small questions. You can do that in homework. And by this note, we will conclude our class for today. Right? Thank you. Sir, class over. Thank you, sir.